Good morning, stock investors, stock traders. It is Friday and it is October 17th. The market has been going up, been going down. It's been a little hard to predict what it's going to do next. We do have a little bit of news that's moving the market. What we had yesterday was a little bit of a scare in the financials arena where regional banks are making loans to automotive companies that are, I think, operating car dealerships, and those loans are going bad. Now, I don't know that it's a widespread problem, but it certainly created a little bit of concern. And you see that the financial sector really did sell off, keeping the market in check yesterday. I think overall the market was down a bit. There were some stocks that flourished. The semiconductor, it keeps going up. It doesn't need cars. It doesn't need anything other than willing companies to buy more semiconductors. Salesforce, they put out a long-term sales forecast, which created a little more confidence in the very successful, proven, large software player. We had some other green spots. Google held its stock price. We had Caterpillar and Deere selling more equipment. Pepsi and Coke, nice safe stocks, were good to go. Procter and Gamble was looking okay. But it was one of those days where, is this something we should be more worried about? These credit issues could really create a lot of issues for the economy, for the stock market, for these banks. And let me get my colleague to weigh in. I'm joined by Daryl. If you're new to the channel, I do fundamental analysis, and Daryl comes in with his knowledge of the charts. How are you doing this morning, Daryl?
Yep, I'm doing wonderful. It's really good to be here, Victor. Hello, everyone.
And any thoughts you have on this whole scare within regional banks and so forth?
Well, it is going to affect at least 2 or 3 banks that made these loans. But the market's reaction was sell now and ask questions later. I still feel really good about the banking industry over the next 4 months, maybe 5 months. I've seen several of them report that have increased their net income margin. Their revenue was reported above what estimates were, earnings above what estimates were. So I think for the most part, most of the banks will do okay. There will be some that could be squeezed. I'm also hearing a little bit about liquidity getting very tight, and that usually causes some consternation for a while.
And when you say liquidity, what does that mean?
Just the reserves, like the Federal Reserve, how much they have on their books. So they've been tightening. They're probably going to move to an easing stance based on what some of the Federal Reserve members this week. And one of the gentlemen that I follow that understands this a million times better than I do, I was looking at one of his articles this morning, and liquidity is getting pretty tight. Doesn't mean a instant crisis, but it is something to keep an eye on.
Got it. When I look at the market for the last 5 days, it's pretty much back to even. We're just down a tiny bit on the S&P. We've had some days that, especially last week on Friday, we had a pretty good sell-off, but the market did recover those losses, and we're back to even. If we compare, I guess, from Friday morning to Friday morning, so to speak. So we'll see where the market goes today. It feels a little bit like we're on weak footing, so to speak, going into Friday, because there is a little bit of fear in the market. Anything can kind of cause a sell-off today. I'm not a day trader. I'm a long-term investor, so no big deal. If we get lower prices, I can buy companies I really want to own long-term. But I'm just kind of calling it the way I see it is I think today could be easily a sell-off day because the market is a little scared. One of the barometers I use is how much gold is being bought. Investors buy gold when some investors are a little bit afraid, and gold prices are going up because investors are buying into it. Any thoughts on gold prices and where they're going? And what does that tell you?
I saw an interesting presentation on that yesterday. I could find it and maybe share it at some point, either today or early next week. But after Russia invaded the Ukraine and the U.S. applied sanctions on Russia, evidently that caused some concern among the central banks around the world. And based on this presentation that I saw yesterday, there was a step up in gold prices, gold purchases almost immediately after those sanctions were put in place, where central banks became a little bit concerned that maybe that could happen to them someday. So this chart that I saw was pretty interesting, how the step up in central banks acquiring gold for their reserves. And then sometime after that, maybe a year and a half, is when we start seeing the retail traders really start moving into gold.
Yep. Okay, good. So that's the market. We've got what are the futures? Where are the futures at?
They were down very big at the end of last night's trading, but they have been improving and we're somewhat back to even.
Right. Yeah, the sell-off really was quite bad, and then it came back. The Dow's back to green. S&P is slightly in the red. Nasdaq slightly in the red. Okay, so the big news this week primarily has been earnings. We have the American Express announced earnings. We have State Street. We had a lot of banks this week. We have more regional banks announcing, including PLP Financial, which provides a lot of auto lending. So I thought it might be interesting to take a look at that. And so yesterday
they were spun off from GM Financial.
Mm-hmm.
So that was General Motors lending arm, and then they spun it off into Ally.
Yeah, that's I think that's the case. Yesterday we had TSM announce, and they had very good earnings. We can talk about that later. Charles Schwab announced, the Bank of New York, U.S. Bancorp, and we can take a look at. I wanted to look at Citi, U.S. Bancorp, Ally, kind of just do kind of a cross section of banking and see what we're evaluating. Citi announced their earnings earlier in the week, I believe on Tuesday. So those are fresh financials. I've already analyzed Citi. I haven't taken a look at Bancorp very closely, but I could do that on the stream, as well as Ally. I haven't looked at Ally, so I could look at that. But there's just good information out there on companies. ASML announced on Tuesday the earnings were good. They weren't fantastic, but they were good. And the earnings from TSM were good. They were on the edge of fantastic because they grew like 30%. They're already, pretty big company. So that looked really good. So the semiconductor space continues to flourish with all the demand coming in. Abbott Labs announced their stock went down some. So there's just a lot to cover. So I thought we would just take a very good topic to take on, which is going to be Citi. Before I jump into Citi, let me check in with some members. Brucey, I've got HAFN on the list. And Magical Self, you want to look at LPL Financial. Yeah, we can take a look at that. Never looked at it. And we will look at it later. Just let us get through a couple stocks we want to lead with. And then I've got a list from members that want me to look at DEFT. And then we're going to look at HAFN. And then we'll look at LPLA. And we'll go from there. Thanks so much for joining. Little Jay, great to see you this morning. Thanks for joining. All right, let's get rolling with Citi. Citi earlier this week announced, and the market did like what they had to say. This bank was sold off. Like JP Morgan is kind of like the standard in the industry. They do really well. I owned JP Morgan for a long time. I like the appreciation. It's just a little bit of an expensive stock. And I thought, boy, Citi provides a really nice proposition to investors. They had to fix a couple of issues they had, and it became a really nice investing idea. And I'm really glad I bought the stock because it's gone from 40 and it's more than doubled in value. So that's terrific. The 1 year is 53, year to date 36, and you get paid a dividend. So you get the best of both worlds, a nice appreciating stock with a nice dividend. That is excellent. It's a big cap, but not gigantic like JP Morgan. 172 billion, revenues of 75 billion, PE ratio of 13.55, and then forward P of 10.4. The analysts believe that it is discounted by 8.7%. Let's take a look at their financials. They have been, let's see here, where's their revenue line? Here is their revenue line here. So this is a big bank. So they'll make money on net interest margin. They'll have different businesses where they do more transaction-based, revenues. And the revenue for Citi has been growing nicely, 9.16% on the trailing 12 months. That is really good for a big, large bank. I think that's what the market really likes is, hey, this bank's really moving up, grabbing, more revenue, more share. And I like that about them as well. And they have been growing their book value. So Citi has been growing their book value really nicely. I valued the stock. It is still discounted for me, so I like that. 15 analysts cover it. They're primarily looking at earnings per share, and they believe this is a good investment for with regards to a large bank. 8.7% is the discount they see collectively. And as they look at a forecast for Citi, they're going to do okay in 2026. They're going to grow by 3%, then grow by another 3% in 2027. I think with lower interest rates, banks are going to do more deals. They're going to be lending more. They're going to be more, hopefully, projects, construction projects, and opportunities for banks to step in and be, that capital partner that, entrepreneurs and builders and developers need to have banks come into the picture and give them that capital they need to do these projects. And earnings per share is really going to expand. So if the stock price stays the same, their PE ratio is really going to drop, but I think their stock price is going to continue to work. So I'm really optimistic on Citi. And let me toss it over to you, sir, to look at the charts on CitiGroup.
So since they came out of the April tariff announcements, the 20-day moving average is this gold-colored line. And you can see that they've stayed pretty much above that. They would come down and test it. They tested it here. Tried to come down here. Didn't quite make it down to the 20-day. Then in August, it came down and traded right at the 20-day. And then beginning in September, it started rising above the 20-day. And then before earnings, which is pretty typical of banks from what I understand, they typically trade lower into earnings. So this pattern doesn't surprise me that it pulled down below the 20. It did even pull down below the 50, which is the blue line. And and it looks like it's trading right at the 50-day, just slightly below it. Yesterday that was pretty much sell all the banks, and we'll ask questions later. I don't know where they are. They are up in the pre-market by 0.25% or so. So the 20-day has declined, but leveling back off. The 50-day is still increasing. As long as it can hold this 50-day, at least until we get through the end of the month, then I still feel comfortable with CitiGroup. The 200-day is down at the $81.65. So 2 days ago, they had an RSI above 50. Yesterday, it did drop down below 50, so it's in bearish territory, 44.59 at the moment. They did have the bearish crossover in bullish territory beginning at the beginning of October. And once again, that was, I think, earnings related. They're trying to move back into bearish territory with the PPO. So the accumulation started decreasing about the third week of September after being at a 52-week high on September the 22nd. The money flow is in bearish territory. And I'm sure you're going to cover the book value, but it's about $106. So you can pick up CitiGroup right now for about $10 off of that price. Most of the other big banks are selling above their book value and tangible book value. So CitiGroup to me looks pretty good if you want to pick it up here.
Thanks, Daryl. So on Citi, when I calculate a price on the stock, I have a 26 collective discount, 26% discount on the stock price. And I'm basing that by trying to value the stock based on its book value and based on its earnings per share value. So 26% discount. I'm a little more bullish on the stock than analyst. I am moving down my discount rate, by the way, by 0.5. If you are seeing my valuations, I was using 8% as the primary. If a company, in this case a bank, is in very good condition, it was an 8, but now it's a 7.5. If it's a riskier situation, small cap, I add more to the discount rate to cover that risk. But based on that 26% discount on Citi, when we look at Citi, their book value is sitting at, this is the latest and greatest off their financials, off their earnings, $108 per share book value. Their share price is 96. They have the best price to book ratio of the big banks. Now you can go over to England and get a better price to book from Barclays. If that's your cup of tea, and they drink a lot of tea over there, then there you have it. But if you look at like JP Morgan, this is what led me away from JP Morgan. It's a little expensive. It's a great, great bank. Okay. But you look at their book value, you look at their stock price. This is a crowd favorite. Sometimes I need to separate myself from the crowd and say, I'd like to buy Citi. And when we look at Citi, oftentimes it's not what you buy, it's how you buy it. And I took an inferior bank compared to JP Morgan, but I bought it at the right time. And I'm sitting on great gains. Citi keeps sending me money in the form of this dividend, so I'm not going to turn it away. I'm going to grab that money and take my wife out to a nice meal, maybe go shopping, and I'm going to watch my stock price go up as well. So buying at the right time, that's what I'm trying to do. Look at the market, find opportunities, seize those opportunities, take care of opportunities. And I think Citi can continue to go higher. Just showed you the book value. It's above its stock price. Analysts agree The economy is setting up for these banks to do okay. Lower interest rates, I think, are going to create activity, more activity for CitiGroup, more deals, more refinancing from homeowners, all that good stuff. So that is CitiGroup. We'll see how it goes today. It's up a little bit, 0.25% in the pre-market. We are 10 minutes from the stock market opening. So that's a big bank. Now let's turn our attention to a bank that's a little bit smaller, and that is US Bank.
Let me show you one other thing on Citi before we jump
Sounds
away.
Good. The floor is yours, sir.
I threw the 10-year treasury rate and subtracted the 2-year treasury rate, because the 2-year treasury rate tends to track the Fed rate pretty closely. But one of the things I want you to look at, as long as the 10-year is above the 2-year, then banks do pretty well. Beginning in 2022, basically the 2-year was higher than the 10-year, so we got a negative delta there, and that kind of hurts banks because they're borrowing high and they can't make much spread on their longer term loans. But we're coming back out of that situation where the 10 is higher than the 2-year. And as that starts increasing, you can also expect the banks to do a little bit better, and I suspect their price is going to increase as well.
Yeah, so good stuff there, Daryl. Thanks for sharing that. And if you're ready for it, I think I have a question for you from one of our attendees here. Magical Sauce asking about the charts. Are you using fast or slow stochastics when evaluating the investment or short-term trading?
I use, like for the PPO, I use the standard values, 12 and 12 week and or 12 day and 26 day averages. I don't actually use any indicators called stochastics themselves. They are available, but I don't use those. I think the PPO and the RSI together provides what I need to provide. One thing I will show you is that I do use faster stochastics on the weekly data, this one particular. So this is 9 and 8 and 17. So this is a weekly chart with, I have MACD on here. I should switch that to PPO. That's what I prefer to use, but they work pretty similarly. But I use the 8 and 17 here. So that's a little bit faster than the default. And the reason I like to watch that is I want to watch for a bearish crossover on the weekly chart with a little faster averages. So this is another reason I've never showed this chart before in any of these shows. But this is one that I watch, and we have had a bearish crossover as of last Friday. So that's something I'm still watching very closely.
Thanks, Daryl. All right. Okay, so good question there. Let's turn our attention over to US Bank. This is a smaller bank. It's not a tiny bank. It's kind of a mid-sized bank. And I know that they're on the West Coast. I'm pretty sure they're also on the East Coast. They've been growing through acquisition. We have JP Morgan way up there at like 800 billion. We've got Citi at 172, and we have US Bank at 71 billion in market cap. P ratio looks even better than Citi and much better than JP Morgan. Forward PE looks real good at 9.6. Look at that dividend. Wow. It's looking pretty good. 4.5% dividend. That looks really good. And this stock over the 1 year, not so good. Down 2.87 over the 5 year, up 16%. Buying this stock at the right times was a good idea. You could have bought it at 29, and seen your stock price go up to 45. So this stock announced earnings yesterday. So US Bank announced earnings yesterday, and the revenue is expanding. That looks good. Now let's take a look at the revenue expanded in the quarter by 7%. That's really good. This is a pretty good size bank. So for them to grow 7% looks really, really good. That looks really good. Earnings per share is expanding nicely, growing by 18%. And there's a lot to like there. And when we look at the balance sheet, let's take a look at that book value, which is important to keep an eye on when we talk about banks. Where is that book value? So book value per share is expanding. We started at 31. And I'm looking at the quarterly, so let me change that to the annual. I think it gives us a better picture on book value. Book value went from $28 per share in 2018. We're up to 36. That is getting the job done by US Bank. The book value is expanding. I like to see that in a bank. That means the bank's getting more and more valuable. So good job there. I'm seeing some good things out of US Bank. What are analysts thinking? We have 19 analysts looking at this stock, and they think it's a 16% discounted stock. They're looking at earnings per share, and when they are looking at a forecast, and I think the regional banks can act a little quicker, right? The JP Morgans, the Bank of Americas, and the Wells Fargos, those are big, giant outfits that they move quite slowly. These guys can move a little quicker. They're going to grow in 26 and 27. Their earnings per share is also going to expand. So I think US Bank is looking pretty darn good. What are you thinking, Daryl, on US Bank?
And they're kind of in the same position that Citi was. So they were trading down into earnings. They are trading below a downward sloping 20. They're trading below the 50-day, which is upward rising, and they're not too far away from the 200-day average, which is at 44.4. So they really need to hold this here because they are priced higher than their price to book. I think there's a little more risk with. By the way, I own USB and I own Citi, but I feel there's a little bit more risk here that I need to consider because they're priced above their book by about $10. Their RSI is in negative territory. I think Citi actually had moved back into positive territory with the exception of yesterday. USB had not moved back into positive territory on the RSI, and they are down as of yesterday. They're down even further. The PPO is also in bearish territory, and we can see the difference between the 12-day and 26-day moving average is about 0.57 difference between those two averages. The accumulation, like Citi, is also dropping a little bit, and yesterday it looked like it fell a little bit more, and the money flow is negative at the moment. So they need to hold this 50-day. They're trading below it for the last week, but I went looking for any downgrades because I thought they got a downgrade yesterday, but I didn't see that was actually true. So I'll have to look into that a little bit more. But I feel better about Citi than I do US Bank, but they're both pretty solid investments, I think.
Yeah, and when I look at US Bank, it's not quite as discounted as Citi. So my valuation is aligned with some of your concerns, which is the book value isn't as impressive, for the price to book, and the earnings per share is okay. I mean, it's a discounted stock by 8%. Analysts think it's discounted even more. And if you just take the earnings per share discount, I am just, calculating a nice discount on earnings per share. But when I blend that with book value, it's just an 8% discount. It is a smaller bank, so there's higher risk. So this one here is not in my portfolio. I'm going to just own Citi with regards to a bank. But this one here, if it could keep growing its book value and really out operate its competitors, they're going to do well. It's up to them. All right, moving on from Citi, let's take a look at a company. And this company was born out of General Motors. General Motors had a big financing arm. I believe they called it GMAC way back when, like 30 years ago. I actually got a mortgage through GMAC. And I remember working with them, and then they spun it off, and it's LPLA Financial. They do a variety of things, a lot of things they do in the automotive space. I thought it'd be interesting to take a look at it. First, they announced their earnings. Second, we had that scare with a couple of automotive companies going bankrupt. So let's take a look at LPLA. This is a $12.3 billion market cap business. The 1 year looks good, 16.8 rise over the 5 year. Boy, this thing's really been places, huh? It really shot up in 2021, came down really hard. I think consistent with what Daryl was talking about earlier, where as these interest rates went up, it really put financial organizations, institutions in a corner where it's like, holy smokes, I'm going to have to pay account holders more money. If I have to borrow money, it's going to be more expensive, and really squeeze these financial institutions. These guys are through that process, and 16% rate of appreciation is pretty good. They pay a dividend of 3.12%, and analysts believe they are discounted by 14.65. Let's see if our friends over at Stock Analysis, I don't think they've loaded the new financials just yet, so I'm not going to be able to talk much about that. But looking at the trailing 12 months, not including the quarter we just closed, they are growing by a little bit. Now, the car business, I don't think is booming, but it's doing okay. Especially, I think the EV tax credit going away created a lot of interest in cars. I could tell you firsthand that I got interested in an EV knowing, hey, that $7,500 the government's willing to chip in on buying a new EV, because I had it on my list. I'm like, yeah, my next car is going to be an EV. And I ended up buying an EV in September. I think a lot of people did. So there should be some additional, dollars and revenue into that sector for the quarter. Hopefully that helps LPLA. We'll see. But these guys have been, these guys can really grow. I think as we have lower interest rates, this might be an idea. We have lower interest rates, boy. You have cheap money. These guys make a lot of money, because not only are they in car lending, they're in consumer finance. They are doing home loans and things like that. Most of their financing is cars, though, from what I'm aware of. So their revenue isn't overly impressive. When we look at their forecast from analysts, there's one analyst that thinks the world of this company. Hey, they're going to be a $70 stock. The worst case scenario isn't too bad at $38. So 14.65 is the overall consensus discount on the stock. Look at this growth. Let's do this. Look at this. That looks really good. So if they grow at 14.5%, my expectation is this stock's going to work, because they're just going to come into earnings going, hey, we grew by 10%. Hey, we grew by 10%. We grew by 15%. We grew by, 17%. That type of growth looks really, really darn impressive. And their earnings per share is going to expand. Look at that expansion of earnings per share. So this one here might be a really nice idea of a stock to buy into and hold during this low interest rate environment. I'm expecting that we're going to see interest rates begin to go down, and they're going to continue to go down. And the feeling is not just hey, I'm going to, pretend that I have a crystal ball. No, it's these are facts on the table, which is the Fed has already communicated they're going to start easing, and we have a president that wants lower interest rates, and he's going to have the ability to put in a chairman that I'm going to guess is going to be committed to lowering interest rates. So if we have that type of environment for 2-3 years, and we have lower interest rates, plus Ali's going to be doing more volumes, I'm really liking this situation. I'm not in love with their financials quite yet, but I think this one here could be an earlier comment I made, which is buying stocks at the right time is really important. And Ali might just be a really nice situation that is going to go higher based on the environment that they operate in. What do you think, sir, on Ali?
The chart's actually looking like it's getting pretty constructive. So today they're up 5.64% at the moment. I did see some sellers step in just a few minutes ago, but it looks like buyers have taken control back. They are trading above their 20-day moving average. The 5-day has turned over and is upward sloping now. They held support at their 200-day moving average on Friday. They are in positive territory on the RSI. They're in bearish territory on their PPO, but they had a bullish crossover today. So those three things are all looking pretty constructive to me. Just like the other banks that we had seen, they had been in distribution a couple of weeks, 2 or 3 weeks before their earnings. So this one's looking pretty constructive, actually.
Yeah, it looks interesting. And it's, see where the puck is headed, right? And
Yep.
I think the puck is headed toward lower interest rates. And just that's a theme. But now you got to pick the right stock. So the homework begins with, I think there's going to be opportunity, but you have lots of choices in financials to pick from. So be aware that, I think financials are going to do well, and it's good to be in them. Pick the right stocks. All right. Are you done, sir?
Yes.
Okay. So moving on, we're going to head into the request from viewers. And Mike, I will be adding AMR to the list. Just hang tight, because we have a nice, it's a good restaurant when there's a line of people waiting to order their food, waiting for that delicious food. Well, I've got a line of people waiting for their stocks to be analyzed. So we've got a total of 6. We're going to start with DEFT. DEFT is DeFi Technologies. DeFi Technologies, a technology company, develops exchange-traded products that synthetically track the value of a single DeFi protocol or a basket of protocols in Canada. The company offers asset management services such as indirect exposure to underlying digital assets, digital asset indexes, and other decentralized finance instruments. It is involved in early stage investments in companies, banks, foundations, and digital asset space. Okay, so we're talking about crypto. So bridging, and I'm looking at their website. And they're creating ETFs. They're getting into ventures. And there's something interesting. Am I wearing? Yeah, I'm wearing this hat. This hat's Celcius. And there was a tech conference that's going on here in Los Angeles. Today's the last day. And there was a session that Celcius, which is a prediction markets play, and there's others out there, but Robinhood actually uses Celcius as their back end. These guys are built on one of the layer 2 cryptocurrency coins. So you're seeing businesses, real businesses, being developed on this whole a cryptocurrency space. And I think it's fascinating to finally see, because I've been a Bitcoin investor, but it's been a little bit like a gold investment. And I've been waiting for when's that, couple businesses that are going to be real and are going to be big, going to take shape. And Polymarket is developed on Ethereum. And our friends over at Calci, I think they're either on Ethereum or Solana. I think it's Ethereum. And there's more businesses like this that are disrupting the legacy that are being built. Back to this particular stock, this space is it takes, I think, an ability or a willingness to look at the potential of this space and see and either believe this space is going to get bigger or smaller. That's one of the first qualitative, decisions that you need to make when you invest in this space. I think it's interesting that these guys are developing products that are specific to DeFi. Okay. Now, I don't know much about these guys, but I am going to learn more about them. I like what I'm seeing. And I attended this conference because I wanted to hear from experts that are developing businesses, and frankly, businesses that are quite popular now, and seeing if it's really working. And it really is. If you want to lay a bet on Calci and you want to bet on like last night's football game, right? I bet you a couple of Steelers fans lost a little money on Calci because the Bengals won. You could have bet last night's football game. You can bet on football games this weekend. You can bet on the baseball games. You can bet on an outcome for an election, all that good stuff. And you're using the layer 2 cryptocurrency infrastructure. So it's pretty exciting to me, because here we are, we're seeing a business happen. DeFi technologies, if you're looking at a stock like this, I would really get to know, what are they doing? What are they trying to play, and get familiar. Are they trying to go into a particular sector within industries to try to innovate or support companies that are innovating in their investments? So that's important to know. What's this stock been doing? For the 1 year, pretty much nothing. For the 5 year, whoa, holy smokes. Talk about buying at the right time, huh? Now, this is a low price stock. Low price immediately means risk. And boy, you could have bought it for 10 cents and be sitting on a real winner, huh? This is a super small cap, 815 million. Revenue, 75 million. Okay. And they have a profit, PE ratio. Okay. And when we look at their revenue growth, 135%. Okay. That looks great. Gross profit, 75. So they're not cash flowing. I'm going to take a look at their statement of cash flow in a bit. So they're 100% margin, I think, because their products, they're probably just charging transactions. So they're not necessarily delivering a service or a product. So that's how they're getting 100% gross margin. They are profitable, but the free cash flow isn't there. I'd like to examine that and understand why. Why is that the case? Do we have two analysts and they think this thing is really discounted? It should be priced higher. Okay. So one thing and when you look at companies in the crypto space, the balance sheets are a new animal. Okay. So what we use with financial statements is generally accepted accounting principles. And those have been, literally created over the last 100 years. And these are disciplines, methodologies that are followed that companies need to report. Crypto is so new, it doesn't fit into the boxes, the categories, the formats that generally accepted accounting principles fit into. It's It's just, you're trying to, you have square peg, round hole. It's not like that. You're trying to fit like, an aircraft carrier, that sits on water. You're supposed to try to fit it on a railroad, rails. It's just not going to work. It's very different. So I like looking at the financial statements and then kind of make my own assessment. Okay, so here's their financials for Q2. So let's take a look at those and see what I'm seeing on the financials with regards to, here's their balance sheet. Perfect. So a balance sheet for a crypto company, you're going to see a lot of digital assets, and sometimes generally accepted accounting principles. It does not give it credit for cash or short-term investments, because it thinks these digital assets are like, we have no basis to give you a value there, so you can't categorize them as, typically short-term investments or cash. So these guys do have some cash. They have digital assets on their balance sheet. They're doing staking. They're lending these digital assets. Okay. All right. And now I'm in the liability section. I'm trying to see if they have some long-term debt, which would be very bad. And I say very bad because this is such a new business. They don't need more problems. They don't need more risk. They need to have the least amount of risk when it comes to debt, and they do not have any debt. So they do have loans payable, but that's in the current liabilities. And that's 7 million, and they have total current assets of almost 700 million. So we're okay on the debt side. So this is super small. If you can read this, you do not need a microscope if you want to go into biology. Let's see here. All right, that looks a little better. So this is how they're making money. So they have realized, unrealized gains on digital assets. This is 2025. Crypto assets have been going up in value. So total revenues of 13 million, staking and lending. And this line here is the biggest one. This is for ETP payables. I don't know what that is, but that's in a very important line. So whoever is interested in this, you've got to do your homework and understand each line here. Understand the business. This is going to be a high risk investment that requires an investor to really do their homework. That way, you know what you're buying into, and potentially the risk and the reward that is out there. So you have expenses. Okay, good. All right. And then cash flow. Why are we in a negative cash position? You're making some money. Okay. These are for 6 months. And you made some money, and here it is. So it's back to that line. This is where the money's being drained, the cash. Okay. So this one here, for me, it's not an investment that I could make right now. It's either a pass, or if I have time, I'll research it more. But it's really high risk. If this thing works, it's going to reward investors. If you bought at the right times, you're already being rewarded. It's just extremely high risk. How I'm playing crypto is, I own Bitcoin. I've owned it since 2017, 2018. And I own Coinbase, and kind of a lighter version of cryptos through Robinhood, because they transact a lot of it. I am interested in maybe adding an investment within the crypto universe. I don't know if this one's the right one. I think this one's a little too risky for me. I'm willing to take some chances and make some money, but this one here just has a lot of things that I can't explain, and I'd probably just lay off. I would not invest for now. I'd have to do more homework. I think there's a lot of potential in this stock. Any thoughts on DEFT?
Yeah, so it does trade in a pretty wide range. I'm looking at some support levels. It traded around 317 for a while. The next support level is about where it's trading right now, which is 203. And then the next one that I see is down around 122, and then the largest support is down around 48. So let's step out to just 1 year, 48 cents. The 200 days down sloping, the 50 days down sloping, the 20 days down sloping, the RSI is negative, PPO is negative and looks to be getting a little bit worse. And we are in a downtrend. So if I annotate this with a trend line, just so we can see it pretty easily. I'm going to go in about the middle right there. So it would need to break above that level before I was interested in. I think there's more risk to the downside at the moment than the upside.
All right. Thanks for looking at that. We're going to move on to a shipping company, Hafnia Limited. Before I do that, let me just check in on comments here. We got them coming in at a good pace. Shadow Guy will probably buy C today. So my bank stocks will be UBS, BCS, C. This guy's Shadow Guy. You got a good part of the planet covered. You got UBS, Switzerland, I believe, BCS, Barclays in England, and then you got Citi here in the US. So good luck with that. All right. Yeah, global diversified. Perfect. Hey, DJ Stocks, you want to take a look at FIGR? It's on the list, sir. You're up to bat. You're batting sixth at this point. So bear with us for a little bit. And yeah, I've looked at FIGR and got some comments there. I have background in software, so I can lend some comments. So Hafnia is a shipping company. It owns, operates oil product tankers in Bermuda. It operates through long range, mid range. Okay, so they're transporting oil. The company transports dirty and clean oil, refined oil products, chemicals, and so oil prices are low. In a general observation is that there's not a lot of demand. That's what drives oil prices down. There's not a lot of demand. Governments, companies are not paying Hafnia, high rates to get oil from one part of the world to the other. They're probably, hey, we have time. We don't have to pay high shipping cost. Let's try to find a low cost way of getting that oil. So that's one of the main themes I'll put out there, which supports or aligns with the stock being down 14.69. If you look at oil companies, they have not been booming. The only space that I've noticed is doing okay is natural gas with regards to energy. These guys here down 14.69. Now you did get a big dividend of 10.79. The market cap is 2.95 billion. Over the 5-year, this has really gone up because this was really kind of left for dead, so to speak, or did they IPO? Not sure what happened here, but the stock did flourish. We had high oil prices for a while. We had demand, and then it's really come down. The 1 year, not looking good. When we look at revenue, the revenue has been contracting. So that's consistent with my high level, and I'm invested in energy. Energy is one of the categories that I like investing in, or I'm comfortable investing in. These guys here are, pretty much going with what the industry is doing. There's not a lot of demand. Oil prices are not very high. So there's not a lot of need to transport oil. There's not a lot of urgency. So the revenue is down. Gross profits, it's still profitable because it's just transporting oil. They are making money, paying that dividend. So that looks okay. Gross margin is getting tighter, right? It's coming down. Operating margins are getting a little smaller. Are we going to stay in this low oil price environment? I think so, for at least the next year. Now, if we get into low interest rates, could that create some additional volumes around the world? Yes. What am I thinking of is, well, if you start, big projects and so forth, maybe you do have more, heavy equipment being used, requires oil. Certain projects would require oil. Now you have this big data center build out, which is the biggest theme we're dealing with. It's probably going to draw on natural gas. And I didn't see that these guys transport natural gas, but what might be a good idea is a pure play natural gas shipping company, because natural gas is probably going to be the energy source that is going to go up the most. So I would kind of point and say that might be an idea. These guys here.
FLNG is one of those.
Which one?
FLNG, Flex.
Perfect. Thank you. So this one here, it's just not, it is not floating my boat, and the pun was intended. And this one's just not going to make it into my portfolio. And the reason for it is shipping is get in, get out investment for me. I see an opportunity, I get into it, and then I get out. And Hafnia, I think there's nothing there for me. I wouldn't want to get into the stock, and I don't think I would make much money because I'm not seeing anything from a big high level perspective that is an opportunity. So those are my comments on Hafnia. What are you thinking on Hafnia?
So the 20-day is downward sloping. The 50-day is upward sloping. The rate of change is getting very slow. And the rate of change on the 200-day, although it's rising, is also very slow. The 5-day did just turn around. It looks like they fell on October the 14th by 4.3%. Don't know what the cause of that was. The RSI is bearish. The PPO is bearish. The accumulation is pretty flat. Been rising a bit since August. One of the things that I keep an eye on with charts is notice the upward sloping price, but the downward sloping RSI. That's called a negative divergence. So I always try to keep an eye on these because it can lead to a drawdown over time because the momentum is slowing down. I can also see it on the PPO, although it's not quite as pronounced. I can see it on the PPO. So the momentum is slowing down while the price was increasing. That gives me a little pause. The money flow is negative at the moment. So I don't know where it's going to go from here. It looks like it could just flounder around for a while.
Yeah, and shipping stocks often come up on live streams and investors. I think the dividend rate looks pretty darn attractive, and at times they've been really good winners, right? But it's brief. Like you got to get in and get out. So I just don't see a ton of opportunity right now in shipping stocks. All right, let's move on. We're going to move on to a company by the name of LPL Financial, and the ticker is LPLA. And these guys, what they do is they help advisors. So advisors, people, these professionals that are helping individual investors, with their investments. They help institutions like banks, credits, unions, insurance. So they're in the financial space providing platforms and services for these institutions as well as the advisory community to get media content and so forth. So that's what they do, LPL Financial. I'm not all that familiar with them. You guys might be. So that's the space they're in. They're in capital markets, financials, not necessarily like they run an exchange like the New York Stock Exchange. They're more participating in the overall sector and doing their services. Year to date, 1% rise, 1 year, 30%. They've really done well over the 5-year. Now, that makes sense because over the last, 5 years, the market has really gone up. The market's brought in a lot of investors and the market's been booming. So yeah, everybody that's providing services to help that boom is probably doing well. Okay, that makes sense. We have a $26.7 billion market cap, PE ratio at 22.88, forward P at 21, small dividend. Analysts think 22% discount. When we look at their growth, let's take a look. Really nice growth year over year, 28.5% growth. Let's look at the categories of kind of income they bring in. So they have interest income and interest expense. Okay, so they have net interest margin, brokerage commission, asset management, underwriting, and other revenues. So these guys are doing services more like not necessarily like Charles Schwab, more like private equity or institutional level services. Okay. They have been growing well. As if you look at Charles Schwab, Interactive Brokers, and so forth, they've been growing really well. So this is consistent with what they've been experiencing. They are not creating cash flow currently. They might be going through a growth spurt, putting a lot of capital into the business. So their earnings per share is good. I'm trying to get to their margins, profit margins. So the profit margins are not impressive. 8%. Operating margins, 11%. So these are not overly impressive. Okay. Let's see what analysts have to say about them. We have 12 analysts covering them, and they think it's discounted by 22%. Let's look at the forecast that these guys have. It's expected they're going to continue to grow. Very good growth. Earnings per share looks good. Earnings per share is going to grow right there with revenue growth and actually expand much faster in 27 and 28. So it looks like a good stock. Looks like a good company. So the 1 year, 29%. It's done really, really well for 5 years. The one thing that this one's a little harder to get my head around, I'd have to do more homework to really understand their business and either establish a sense of, do I think their industry is going to do well or not? And, I'm not going to take 30, 40, 45 minutes on a live stream to really get to know them. But I would do that as an investor, really get to know them, understand their business, and make a decision on, do you think they're going to do well given where we think the market's going to go as a whole for financial services. For me, this one here is interesting, but there are a lot of interesting things in this space, right? There's easier stocks to get our heads around, like Robinhood, Charles Schwab, Interactive Brokers. There's a lot of stocks that I could easily get my head around. This one here is interesting enough to do more research on. That's as far as I can go with my research. What do you think about LPL?
Yeah, one of the things that I noticed right off the bat is the 20-day is crossed below the 200. And then about 5 weeks ago, it looks like the 50-day is crossed below the 200. And they put this really scary title on that. It's called the Death Cross. And usually when these Death Cross bottom out, it's usually a pretty good time to buy. The other way, when the 50-day crosses above the 200, is called a golden cross, and by that time it's too late to buy in. So you got to buy them when they're struggling, and this one is struggling a little bit. So the moving averages are in the wrong order. The 200-day is the only one that's rising. The 50-day and 20-day is declining. The 50-day did, or 5-day did turn around, looks like on the 6th of October, and has been moving up. The trading today is a lot of indecision. We've had high as like 337, as low as 325, and it's trading pretty much right where it opened. So we've been open for just 35 minutes, but it's right dead in the middle of that. So buyers and sellers can't decide who's going to be in charge here. So the RSI is bearish, PPO is bearish, but we did have a bullish crossover. Looks like 2 or 3 days ago. The accumulation is or in distribution mode. The money flow is kind of sitting in no man's land. It needs to get up to at least 0.05 before we can call this bullish. So the indicators don't look good at the moment. Looks like it might still have some pressure put on it.
And Magical Self added a comment on LPL. They're one of the largest 401k managers in the U.S. and 401k money just keeps getting bigger and bigger and bigger. Right? It's really the lane that most people that are employed take toward retirement. They're putting money into 401ks, and these 401k companies are getting bigger and bigger and bigger. So if they are in that space, that's a pretty fertile ground to be operating in. So I would say that much. All right, good stuff. So if you're ready, there was this question that's really aimed for your attention, which is if you can look at CELH and answer the question, are you seeing a cup and handle chart on, I think it's Celcius, CELH.
Okay, so I do see one. Let me step down to just 6 months here. So for people that aren't familiar with these, let me draw what a cup and handle is. So it's basically when you have...
Can I give you a visual? This is a cup and handle here, right?
There you go. It looks almost identical to that.
I have a cup and handle in my hand. Back to you, sir.
Yep. So then let me draw a trend line with an arrow. So a cup and handle forms when you've had an uptrend, and then the stock makes a base and then creates this little handle, and when it breaks out above that rim, then the cup and handle is completed and ready to make its move. So let me save this because I have so many of these stored that have actually worked out. So this is a cup with handle. And then he asked about the target. So let's go ahead and calculate that. So basically you go to the right rim, and that was 63.93. So 63.93. And then you go down and measure the bottom. So that was 50.80. Subtract that from the price at the rim, which gives me $13.13. And then you add that to the price at the rim. So that gives me a price target of $77.60. So I will go ahead and add that. So the price target is 77.07, and I'll save this and we can come back to it in a month or so and see how that worked out.
Excellent.
I have probably 5 or 6 of these with save charts, and at least 4 of those 6 have worked out almost to the dollar on that price target. So these do work, not 100% of the time, but they do work quite frequently.
Perfect. All right. Thank you, sir. So we're going to move on to a med device company by the name of Edwards Life Sciences. And I am very familiar with these guys because they are located not too far from where I'm at right now. And they are a success story in Southern California. And they're a biotech med device company, provides biotech. I keep saying biotech. Med devices for cardiovascular diseases. So if you need heart valves, you need things around your heart, which a lot of people do need, then you look, or surgeons, doctors will look to Edwards Life Sciences for. These guys are a $43 billion market cap company. The stock's up a little bit today. Over the 1 year, it's up 7%. 5 year, not so good. Not so good at all. Market has not liked this stock long term. And the P ratio looks pretty good this year, but next year it's going to go up to 28. Interesting. Looks like profits are going to drop. Revenues of 5.69 billion. Analysts think it's discounted by 17.9. Now, looking at their revenue, it has been expanding. I'm not quite sure why the market has not liked this stock. Like, it's growing its top line revenue, but let's keep looking. Maybe we're going to find a problem with the company. So the revenue looks pretty good. This is, the healthcare space is one that should, classically be a safe sector. If you're in recession, you're still going to go get healthcare. You're not going to put off, surgeries or treatments that are going to keep you healthy. In some cases, extend your life, keep you alive, and so forth. These guys here, I think, make good profits. Let's take a look at their gross profits. And their gross profit is really high. Look at that, 78%, 79%. So the market still doesn't like them. I don't care that you make a lot of money and you're growing. Oh, you make cash flow too? I still don't care. It's like, man, when are you going to start caring about these guys? So that's interesting that that's the case there. Profit margins, geez, 73%. Is that a misprint? So is there something there? Are they being sued or something? Is there some news? I'm going to check on that later. 17 analysts cover it. Some analysts think it could go higher. It could also go lower, according to one analyst, but consensus is that it is a discounted stock. They're going to keep growing. We have an aging population, right, in the U.S. and internationally. You have countries, South Korea, Japan, countries in Europe. The population is aging, And we have a pretty good portion of people that are above the age of 50. And the reason I say that is when you're looking at a company like Edwards Lifesciences, older people start having heart problems and they start seeing that, hey, I'm going to need one of these valves or I'm going to need something from this company. So that is going on there. Whoops, I scrolled down. I shouldn't have. So the revenue growth looks good. Their profits are going to expand. That looks fine. So here's a big drop in profit. I wonder why. So that there, I'll have to figure out what happened. Like, why was there maybe some government decision where they used to cover a particular procedure and now they're not covering it at all? So that created a big loss of profit, potentially. Have to look into it. So that's a first sign of trouble there. Let's take a look at their balance sheet. So their balance sheet, they have $4 billion in cash, $700 million in debt, no debt, $3.3 billion of net cash. I'm seeing a lot of things I like here. So let me toss it over to you for the charts, and I'm going to do a valuation on Edwards Lifesciences.
Okay, I typically draw trend channels like this on longer term charts, like 20 years. And this is only a 3-year chart, and the trend, this channel is only from August of 2024. So you have to take that into consideration. I have other charts that go back 20 years, and those can be pretty powerful when you see a stock that is continually rising over a 20-year period, and then it either breaks to the upside or breaks to the downside. They are pretty powerful. So this one is less powerful because it's only since the middle of last year. But I wanted to draw that on there first. So I've just connected these lows, and I made a copy of that line and just drug it up to the top and try to connect as many tops as I can. And then I made a copy of that and changed it to a dotted line and moved it to approximately the center. So what I'm pointing out here is since last, well, first of all, first thing we should look at is what in the heck happened here. They were at 67 and they dropped down how 30%. But that's when the uptrend, this trend channel started. So now that we have that established, let's drill in just a little bit. And we can see that the 20-day is crossed below the 50-day, and it looks like the 20-day could actually cross below the 200-day, but it is at the bottom of this trend channel. So based on this, probably not quite 18 months, probably 16 months, this support, this bottom trend line could act as support here. And it looks like it trades, could trade up to 84 based on this trend. The 200-day is looks like it's starting to decline as of about 3 days ago. The 50 has been declining since the 8th of September. The RSI is pretty low at 36, but it is improved. Well, it's improving a little bit. The PPO is negative. They had a bearish crossover on the 9th of October. Does look like the delta between the two moving averages is maybe getting a little bit smaller. What is interesting is the accumulation is still pretty high and the money flow is high. So it looks like buyers are starting to step in here, which gives me even greater confidence that maybe they've reached a low on this bottom half of the trend channel.
Excellent. Thank you very much on that. And looking at evaluation for Edwards Lifesciences, I did like a lot of things I was seeing with like revenue growth and so forth, but the cash flow was a bit low. And when I look at the value based on future free cash flows, it's really priced too high. So the market somewhat has, treated this stock like it didn't have a lot of desirability. And it can understand why if you look at the value based on free cash flows, they're just really low. So that's unfortunate. And I looked at its history. It has never really produced very high free cash flows, which is a surprise since the margins are really good. And there's other aspects that look pretty darn good. So that is something that is interesting. And then when we look at earnings per share, it also is not overly impressive. I'm not giving it a very high PE of 18 because healthcare stocks are just not getting very high PEs. So even on earnings per share, the stock is priced 22% too high. Collectively, it's priced 41% too high. And the market has been, pretty much not buying it, not buying this stock. I'm not buying this stock. It's like there's not enough there. If I'm kind of the things that I can't, figure out is how can you make this kind of margin and not have it land on free cash flows? And historically, they haven't been like a just strong cash flow company. That's an important line. So for that reason, this one here, it's just we're not even close. I could research it and maybe make it a little bit more attractive, but at the end of the day, it's in the red zone. I don't want to spend more time on it because it's not a buy. It would actually be a sell. And I would move on. There's other healthcare stocks that look fantastic that I'm going to put my capital into. So that is Edwards Lifesciences. Moving on to a stock that has had a ferocious graph, and that's Alpha Metallurgical Resources. This stock has been hated. It's made a comeback, and according to comments from Mike, it's had kind of a pretty solid sell-off. Now, I decided to buy into this stock. I thought that a couple of things were going to make materials stocks, and man, if I would have gone rare earths, I would have really killed it. But instead, I just made a very good return on this, like 50-60% appreciation over the course of 3 months, which is very good in my book. Thank you very much, market. But I bought this stock because a big famous investor had been betting big on this stock. Look at the 5-year. This thing had been a $400 stock. It'd been beaten down, sold off. Market doesn't like it, but it's been making a really nice recovery. So I bought into it. I decided I'm out. I wanted to de-risk my portfolio a bit. I got out of it. And that was always the plan with AMR. Get in, get out. Once I had a certain rate of appreciation, I was going to get out. I did so. I'm going to pay short-term capital gains, but so be it. There's worse problems in life than paying taxes. This is a $2 billion market cap company. Revenues 2.37, forward P of 17. These guys create the coal that goes into steel production. So this is metallurgical coal. It's not the coal that's going to be burned and created into or turned into electricity. And my feeling was that, we're having the leadership of the U.S. government wants to have more domestic production of products. And I think that potentially steel is one of those industries that is going to be highly protected. And we're going to need more domestic coal so that the steel producers can produce the steel. So that was my theory. And I also saw that, some other activity. So that was the investing idea. I decided to get out because I think it's getting riskier. And will we have the kind of demand on this product that I expected? Maybe. But the revenues have been coming down. It's a combination of the commodity price hasn't had a very good price for producers and the volumes. So this is reality that, hey, these guys are not killing it. They're actually struggling. And free cash flow is there. Gross margins, this is commodity, right? So low commodity price means I'm not making as much money. If the commodity price goes up, they make more money. Like back here when we had supply chain constraints, boy, these guys were making money hand over fist, which is what resulted in that $400 price for the stock. So this one here was just purely a get in, get out situation. And I got in and I got out. Analysts think it's discounted by 7.5%. Looking at the forecast, these guys may grow their revenue in 2026 by a good amount, 22%. And their earnings per share is going to be 17. But you see that their financials, it's not like, a beautiful expanding chart. Kind of like if you look at like Microsoft, wow, man, they grow at 20%. Nice smooth charts. No, this one is like, whoa, not smooth at all. So my value of this company, let me show that to you, and then I'll go over to the charts, or we'll send it over to Daryl. These guys are very discounted because the stock is so beat down, but you can't, my intent is not, I can't depend on the discount rate. I need to look at the overall picture and make that qualitative decision. And I made the decision months ago, got in, made money, got out. And I don't want to be in the stock right now. I think right now, I don't know what's going to happen, if AMR is going to go up or down. So those are my comments on AMR. What do you think, Daryl?
I'm trying to figure that out. I was drawing some stuff on here while you were talking. So they reached their peak. It looks like, at least I only looked 2 years back, but it looked like they reached it February of last year. That sound about right?
Mm-hmm.
Okay. And I drew a Fibonacci retracement over here just so we could look at this bottom to the top that I see here in December, which was also part of that downtrend line that I drew. So it tried to retrace from this bottom. It tried to retrace and couldn't get back to 50% before it started rolling back over. The 20-day looks like it is declining at the moment. The 50-day is still rising. The 200-day is declining, so that confirms this downtrend is in place. So it looks like it's running out of steam. It has not been able to retrace above the 50% point from this low. It did break out above the trend line for a month or so. Traded right at that trend line and is recently broke above that, but I don't know if it's going to be able to hold that trend line or not. It's trading below the 50, well, maybe just a little bit above the 50-day. That'd be another support line to keep in mind. If the market continues to struggle, then, and if it breaks this 50-day, then you could expect a price is closer to this trend line than where it is now.
Thanks, Daryl. That's a tough one.
Yeah, it is a tough one.
All right. So let's move over to Figma. And Figma, I'm sorry, this is FIGR Technologies. I thought we were going to go to Figma, but maybe I read the comment wrong. Is this a new IPO? Yeah,
yes,
it was.
That's what he wanted to analyze.
So FIGR Technology Solutions, develops, operates blockchain-based consumer lending platform. The company offers a suite of blockchain-based solutions for its marketplaces, including lending, trading, investing activities. It serves consumer finance sector. Okay. All right, let's take a look at their website. Interesting. So unlock home equity for all your needs. So these guys are doing a lot of home equity, which is going to become pretty darn popular with very low interest rates. You can do debt consolidation. You want to finance your solar panels. And it looks like the home equity line of credit. So this is, you can start a business, but you're using the equity in your home as collateral. Okay. So consumer finance, that's what they're doing. Now, how are they? I'm understanding what they're doing. This is like a business that's been around forever. So they're doing it on the blockchain. Okay, so this is interesting. So you have a pool of assets, crypto, and somehow they're putting that into this particular business. I don't quite understand how. So I'd want to dive deeper into understanding the business. Let me take a look at their fundamentals and see if this would be like, hey, I really want to dive into this business. So 9.3 billion in market cap, PE ratio is 31, moving to 63. They just IPO'd. Now, it tends to be kind of a pretty disciplined rule. I don't invest in IPOs. They could be terrific businesses like Reddit. They could be terrific businesses like Robinhood. It could be Meta. It could be anything that's superb, but it IPOs and it tends to settle down. I could show you example after example, and I would say at least 8 out of 10 companies, the stock really sells off, and it gives you the opportunity within the first 2 years of that stock trading. So this one, just put it out there that, hey, I don't touch IPOs for that reason. It could be a terrific business. Like I bought Reddit. I've made great returns on Reddit, but I bought it after the IPO, well after it settled down. That's a recent success story there. So these guys here, let's take a look at their growth. And part of why I try to stay away from these guys is we only have a little bit of history, right? So these guys are growing. That's terrific growth. Perfect. But they're tiny. Are they going to hit a wall? Is their competition going to say, well, we're not going to let FIGR come into our marketplace and take business away from us? And they lure customers away, and then FIGR stops growing. Well, if that happened, boy, this stock's really going to suffer. So I'd like to see it grow more. Earnings per share. I'd like to see more years of history, more quarters of history at a minimum. So they're doing fee-based transactions. They just charge a fee, 100% gross margin, which theoretically is true. If they're just providing a platform, they already bought the platform. I guess if you wanted to be super anal, you are spending electricity, spending some type of resource to deliver that to deliver that service, but we'll just leave it at 100%. That is really high, obviously. You can't go higher than 100%. And they are profitable, so that looks good. Okay, so let's take a look at, and what kind of cash flow did they have? So gross margins, they didn't put cash flow here. So operating cash flow is negative. And why is that? So we have a profit. So they had a gain on the sale of assets, and that's a paper gain. So you have to undo that. That paper gain is in your profits. So you have to undo that. That's why it's a negative number. And then these numbers make sense. Okay, that's fine. So that's why we have negative cash flow, is most of that profit was a paper gain. And that's why you want to give IPOs some time. It's kind of like, hey, you have to run your business and prove to investors like me that you have a very good business. Okay, so that looks okay. So we have 8 analysts covering it. Price targets from 40 to 54. So these guys do believe in the business. We don't have a forecast. No forecast. All right. Well, that's part of my reasoning of I stay away from IPOs. I need more data. This one here, they don't have free cash flow. I'm not going to provide a valuation on this. It'd be a guess. These guys are saying 20%, maybe. But I'm taking a high risk. This is a new business, right? Using liquidity pools, I guess, within crypto. I really would like to get to know this business more, because it's going to educate me in this area, and maybe not necessarily investing in FIGR, but maybe I invest in another company that's similar to them and I make lots of money. So I'm going to research this just so that I can become more informed. But this is not an investment I would make in the next year. It's not something I can get a value to, because it would just be a shot in the dark. Like, I don't know. It might be this, might be that. No. Instead, I would just say too soon after its IPO date. I'll let other investors take the chance, maybe lose some money, because most IPOs settle down, meaning you lose like 60% of its value or so. Even the great Reddit, and another stock that I'll point out where I did that was A-Lab, right? This is a fantastic business. It IPO'd recently and settled down a couple of times. And more recently, it just jumped up big time. But the market said, hey, knock, knock, who's there? Opportunity. And I bought this stock here, and it went up really nicely. So these young companies have fantastic businesses, and I get more data. They are absolutely a place where I want to make some money, but I just need more information. And FIGR might be a terrific business for the future, but I just need more quarters of financial results for them to prove that, hey, we have a good business going on. Now I'm going to flip it over to you for charts, but I don't know if you have many charts on this business.
No, there's not enough data to even look at for charts.
All right, we will have to cancel the chart request on that, and maybe in about a year we can get you some charts. So there's a question from Saeed on Barclays. So Barclays is a big bank, and we kind of commented on it earlier. And the question is, with lower, their earnings are coming. And will lower interest rates in the future hurt or help Barclays? And the conclusion that we're forming is that it's going to help big banks. It's going to help banks. Their lending cost is going to go down. Their borrowing cost is going to go down. So it's also going to spur, in my opinion, higher rates of economic activity for the bank. So that's good. You're going to have people going, hey, I want an equity line of credit for here in the United States. I don't know if they have that in London or in England, but hey, I want to borrow against my home. Okay, perfect. Here's the line of credit. And shazam, the bank's earning the overnight borrowing rate plus, maybe a spread of 2-3%. So all those things start to happen as you have lower interest rates. So lower interest rates are going to help banks is the conclusion. Any comments you would add on to that, Daryl?
Oh, that sounds pretty appropriate. I don't know what the differences are between how European banks operate versus US. I'm definitely more familiar with US banks. But I think in general, I think what you described is pretty much right on.
Perfect. Okay. So do you still believe in DocuSign? So I think that's aimed at me, and the answer is yes. Now, so DocuSign 1 year, not doing great, 5-year, because it was priced so high, but it's not about, buying it there, buying it at the right time. You could have bought DocuSign at 38 and be sitting at 67. What do I like about DocuSign that I think is keeping me in the stock? I have a pretty good sized position in DocuSign, and I put in half the money and the market put in the other half, meaning I'm sitting on a nice gain and my investment has appreciated in price over that term. They continue to consistently grow. This is the digital capture leader in the marketplace, integrated into so many different products. And no matter what AI does, I don't think we're going to have AI forging signatures, or at least we shouldn't have it do that, right? If we need somebody to commit legally and they have to sign, you're going to have to digitally capture that. And DocuSign does it. So 8% growth, and their profitability is really, really good. So the profitability is nearly 80%, really high rates of cash flow. They have the moat being its network power. What keeps competitors away is DocuSign is the standard, the most popular digital capture solution out there. So I like that about it. It's a small cap in relation to other software businesses, and it makes money. It makes free cash flow margin. I think it's setting itself up to be a very attractive acquisition target. And the stock is not priced too high. Software stocks have not seen they're not being priced up by the data center build. They're not priced up by the big AI push, because the market, or I think general theories are, will AI hurt the software industry or will it help it? That's a big question, right? I think it's going to be for the next 5 years, it's going to be very little impact. And here's a perfect example, which is you're doing digital capture. How is AI going to affect that? When I sign for something, if I'm taking out a home loan, or, I bought that car I was talking about, it was all on DocuSign. They have tablets at the car dealership, and it was all DocuSign. I walked away with no paper in hand. They gave me a flash drive and said, you could also log into the portal and get all these documents and download them. Bingo. So there we are, a digitized process. Good for them. Good for me. So those are my comments on DocuSign. And let me show my valuation on DocuSign. That's very easy. In DocuSign, I will change the discount rate because we have lower interest rates. It's nicely discounted. In these discounted stocks, it's just like having a really good, solid, investment. I'm up on the stock. Every time they announce earnings, it reminds the market, this is why this company is valuable. And I am good with DocuSign. It's a good hold stock for me. There's a lot of attractive software investments. The investment I'm making recently, again, if I did not own DocuSign, I would buy it. I'm an owner of a list of 8 or so different software companies. The one that has caught my attention, because it's rarely ever discounted, is Intuit. Intuit is rarely discounted, and it's being discounted right now. So I am buying up Intuit. I own a lot more DocuSign than Intuit, by the way. So those are my comments on DocuSign. You got anything to say on DocuSign?
So the 200 days declining, the 20 days declining, and the 50 days declining is trading below all three of those. The 20-day just crossed below the 50-day. RSI is in bearish territory and the PPO is in bearish territory, but you can see the delta between the two averages is decreasing. Lot of distribution at the moment. Looks to be almost a 52-week low, and the money flow is negative. But given what you said, I was looking out a little bit further, and there were some times to pick it up relatively cheap. It definitely got way overpriced here. This looks like a pretty good support level. If it gets down to, what is that, 63 or so, that would be a good time to kind of pick it up. I did while you were talking, I did put a chart of Rocket underneath this one just so I could see if there was any parallels when mortgage companies are doing well. Does
Right.
DocuSign do better? And there, I probably do correlation, but I'll have to probably do that offline. And if we want to talk about it again next week, I can
That's a
do
good
that.
point. If you're doing more home loans, boy, there's a lot of digital signing
Yep,
going on.
exactly.
Awesome. Well, thank you, Daryl. Great work today. While you have the screen, we're kind of wrapping up the show here. What's going on with your channel? And can you tell us about your channel and maybe going into the weekend, anything that we should keep our eye out for?
Yeah, let me pull it up here. So this week I published earnings preview for J&J, Citi, and I did one for RTX, which announces next Tuesday. There'll be two more that I'll be putting out probably this weekend. Then the following week, I have a whole bunch of companies reporting. I don't know how many of them I'm actually going to get to build videos for, but I will be putting out videos on the holdings that I have and what the earnings preview is.
Excellent. Well, thanks for doing all of that. And thanks so much for your review of charts in today's stream. We had a very lively crowd of people on the live stream. Thanks everybody for joining and for making it a really interesting stream. And we had a ton of questions. I wanted to come back to a couple of thank yous, and thank you, Kennedy Francis, for becoming a member. We've had a really nice, or I have had a very nice increase of members lately. And thanks to Kennedy again, Steve Mackey, Christopher Scheller. I really appreciate you becoming members, and please get me your email address so I could give you a list of the perks that you have. And thanks to all the members who attended. Really appreciate your questions and your interest. Looks like the market doesn't know what to do today. Is it going to go up or is it going to go down? We've got the NASDAQ down a tiny bit. S&P is up a tiny bit. My guess is we're going to sell off. I think there's enough risk out there where investors are probably going to say, you know what, let me just get out and have a nice weekend and come back next week. Next week, as Daryl mentioned, we've got some big earnings coming, but they get even bigger in about 10 days. In about 10 to 15 days, we're going to start seeing some massive ones. Next week, we've got some interesting ones, Netflix, among others. So those are interesting, but I don't think they move markets the way that the big Microsofts and Google Alphabets. I think those are going to really set the table. If those stocks come out and say things are awesome, market's going to move higher. If those companies come out and say something other than that, maybe something that's more cautious and careful, the market's going to pick up from that buy and maybe sell off, maybe just take stock prices down, which is it? Maybe some medicine we need to take. It's great to see stocks rise over time, but sometimes when they get priced way too high, way ahead of their valuations, we need to bring those stock prices back down to earth. We'll see what happens. So that is the stream for today. Thanks again, everybody, for tuning in. Really appreciate your attendance, your questions, your interest, and keep it coming. We're going to stream again next week, and look forward to having you attend. Bring your questions, bring your requests, and have a terrific weekend. Thanks again, Daryl. Have a nice weekend.
Thank you, Victor.